Hi guys, this is Craig, the options linebacker, and this is the weekend report for Saturday, August 29th. So what's happening in the markets? Well, the first chart we'll look at today is that of the NASDAQ daily chart, and there's a couple of interesting signals on here. First of all, since the March bottom of this year, the market has actually retraced 50% of the entire bear market move, signified by this yellow line. Now, what's important about that 50%? This is where most major recessions bounce back up to. So we saw this happen in 1930, where it bounced back about 50% and then rolled right back over again. And we can compare that versus what happened in 2003, where it bounced back up 50%, and then 2004 was more of a consolidation pattern before it started heading higher again. So one of two things will happen with this, but in both instances it was that 50% retracement which was significant. Now the second thing to note here is just the shape of this particular rally that's come off the bottom in March. Imagine that you were climbing a 15,000 foot mountain off of sea level. You'd probably sprint up the first 6,000 or 7,000 feet rather quickly before taking a rest. You'd feel great, and so you jump up to maybe the 10,000 foot level, and now you're starting to feel a little bit tired, a little bit disoriented. You're losing a little bit of oxygen. And so you take a rest up here, and then your next attempt to get up to maybe 12,000, 13,000 feet isn't going so well. You're not nearly going as fast as you were when you were around sea level. So we're saying the same thing on this rally, is that the big moves are always made off of the bottom. And the question is, what is the reason to buy? The higher up we go, is there more of a reason to buy? And we've not really had so much as a decent pullback all the way along here, so a lot of the mutual funds are sitting on the sidelines trying to patiently wait for that pullback. Unfortunately, it's just not coming. So just standing back and looking at this rally, you can tell just by the eye that it's kind of running out of gas. And we appear to be running on fumes as we get up here, because this week has actually featured some good economic reports, and it hasn't led into any sustained buying. Whereas a month ago, it would have sent the market straight up another 20, 30 points on that particular day. Now, the last thing that I'll mention about the NASDAQ chart is that the price has now come back up to retest the crash that occurred starting in early October of last year. The price has now come up to test that level, which again corresponds to that 50% retracement level that we talked about. This is an important milestone because after crashes, after breakdowns like this, the price will tend to come back. It's as if you dropped a super ball off a 10-story building. You're going to see that thing bounce very hard off of there and come up to just about the same level. Now let's switch over to the S&P 500, which I think is the best chart to look at on a day-to-day basis. We're going to look at the monthly chart on the left, the weekly chart on the right. And the monthly chart showing obviously something interesting here is that the price is coming up to this trend line here, which represents, you can see, all the significant lows really since the mid-90s have followed this trend line. And now we've broken through that last year in the crash, and then it's coming up to test that from underneath. Very common pattern. So you can see that it's starting to show some effect and a little bit of overhead resistance at that level. But the weekly chart is in disagreement with that, because right now the weekly chart is showing that that breakdown completion is right around that 50% fib of the bear market. Again, same deal here, and it's got about another 90 S&P points to go before it's going to run into that level, as well as running into this trend line, which marks the top of the channel for the entire bear market up to this point. So it's very common if you see it fall out of here to come back up and retest that. So we do have kind of a target overhead on the S&P of about 1120. So between the monthly chart showing overhead resistance and the weekly chart showing kind of an unfilled gap here and an upside target, we'll see which one wins. Now if we move down to the daily chart in the S&P and throw some indicators on here, we can see first of all the Bollinger Bands are showing that there's some overhead resistance here on the S&P. It's going to be kind of like pushing on the rings of a boxing ring. The price can do whatever it wants to inside the ring, but once it starts pushing on those bands or the ropes of that boxing ring, the ropes are going to push back and try to keep it within that area. The second thing we're seeing here is that we're seeing clear bearish divergences on the MACD histogram. So as the price has been going higher and higher, we're hitting lower highs on the MACD histogram as well as the stochastic. So it's clearly showing objectively that we're running out of steam as the price is going higher. Here's a chart of the VIX, or the volatility index, and we can also call this the fear gauge. So if this is the fear gauge, there is no fear down here because we're just showing a very low value, although we have diverted from the mean by quite a ways. This 200-day moving average represents the mean. The VIX is a mean reversion instrument. Eventually we'll see this come back up to this point, and that would be also followed by a significant move down in the market. So we're going to have to be on guard for that, because right now we're showing an extreme Bollinger Band squeeze. And the analogy for this is, imagine holding one of those wet, slimy orange pits in your fingers and pressing on it really hard. Eventually that thing's going to go flying out of there. You don't know which direction, but it will pop. And that's exactly what happens with these Bollinger Band squeezes. We'll see quite a move coming out of here. Don't know when, don't know which direction, but be on guard for that. Just a little Econ 101 here. We have the chart of the dollar, and as long as the dollar index is in this channel and heading lower, it's going to provide support and potential higher prices for equities. They have to, because if the dollar's being devalued, if Ben is sitting in his basement printing money, then prices of assets have to go up to remain on par value. But watch very carefully to see if this price breaks out above this channel, which all descending channels eventually do break out to the upside, because that'll put a lot of negative pressure on equities in the short term. And here's what I call the evil twin of the dollar, which is crude oil. And as the dollar continues to sell down, crude oil becomes an attractive commodity hedge against that. So you can see how well this trend line has followed in this. And this is a classic kind of a pennant squeeze here. So typically what happens to these is a upside breakout, but watch out for the fake outs, such as we saw just last week. And I'll finish up today's video by looking at the Russell chart, and this is where we have our current September positions in play. We have a bullish position down here, bullish credit spread. So in other words, as long as the price closes September above this price, we win that position. Now I do have a defensive butterfly in the way. So as we know, these credit spreads, they don't like the price to come towards them. We got about 3 weeks left to go. So what have I done here? I've added this kind of potential blocking device here. This is a put butterfly, so that if the price does wander down here by September expiration, represented by this green line, this butterfly will actually gain in value. So it'll help hedge off this credit spread position down here. So things are looking very good. We have a lot of distance for September expiration, and we should be able to either close this position down for a very cheap debit to take early profits, or if the price is going to continue to go higher, then we should be able to just let it go and expire worthless for a max profit. Now we're starting to put on our October cycle offense, and I've detailed those trades in the Options Linebacker newsletter. And I think that we're going to see some price breaking free of this logjam here pretty soon. So we can expect a lot more volatility as we get into the fall season of 2009. And that's it for today. Catch you next week, folks.